Good morning, everyone, and welcome
Morning.
to our DAT IQ weekly market update. This is our last update for March of this year, March 28th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and making his illustrious return back from Louisville, Kentucky, all in one piece. We have Dean Croak, who's our Principal Industry Analyst.
Yep.
Morning, gentlemen.
Good morning.
Morning.
So how was Matt's, Dean? Did you win?
Yeah, I'm not part of that club, and I don't know what club that is, but it's the club that never wins anything. I entered my truck in the interior, which was kind of odd, and they never even bothered to look inside or get up inside the truck. But it was great to catch up with a lot of people. It was the number of people that came up to the truck and were talking about our shows, our collective shows, was amazing. A lot of people didn't realize that my voice was one and the same as the person that owned the truck, which was more fascinating. So I'm not sure that's
funny.
a good thing. Yeah. So it was a great show. We did a lot of podcasts, a lot of webinars. We did a lot of live camera shots, being interviewed by a number of folks out in the truck lot. So a very successful event, both outside in the truck show area and at the booth.
Awesome. Yeah, it was, from everything I heard, it was super well attended. It was like the first real one back since COVID, right? So heard it was super well attended and really good time. So for those not familiar with the show, maybe you went to Matt's and heard about it and decided to tune in for the first time. We're here almost every Tuesday morning at 10 a.m. Eastern, talking about trends in the freight market, what we're seeing, ways that you can stay ahead of market changes. But most importantly, we're here to answer your questions. So if you can, drop them in the chat or comment section below. Our marketing team will feed those over to us behind the scenes, and we will answer those towards the end. So with that, I will bounce over to our points of the week. Dry van and reefer spot rates, and we're talking about line haul here, continue to plunge for dry van and reefer, but flatbed, again, coming online seasonally, showing some strength. Tonnage index from ATA up 2.4% year over year, but flat sequentially. Retail sales, again, this is going to be something we're going to talk a lot about, is my guess, over the next couple of months. Really showing some softness. As you know, it's a huge fuel driver for, well, bad pun, but it's a huge driver for trucking. So something to watch. Domestic produce volumes down. And then, this last one I think is more of like a keep it on your horizon. I don't think there's any actionable data on it yet, but there are some very interesting things to keep aware of happening in China. So with that, I'll turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. Yeah, it was a great article in the Wall Street Journal where they interviewed some of the folks at the port over there, and they were talking to shippers that are already bringing in some of their Christmas and fall volumes now, because they're very worried about both the contract agreement with the West Coast port workers coming up in July, I think, or June maybe. So lots of consternation on the side of the shippers, especially on the importers looking to get capacity and find alternate markets in the event that the Los Angeles port doesn't improve, although it is improving. So let's start off this week's market update with a look at our load post volumes in the dry van side. Load to truck ratio are relatively flat this week at 3.87, down from 4.44. Dry van load post volumes continue to slide, down another 12% last week and down 30% compared to the prior month. So ending at just under 4 for the first time in quite a while. In the refrigerated sector, as Ken mentioned, I've been looking for reasons for why we've seen such a loosening in capacity in the produce market. Again, we're sort of pre-produce season. We're at the starting line. The Vidalia onion season's pack date is the 12th of April, so that kind of signals that we're starting off the produce season. But volumes have been dropping substantially. According to the USDA, domestic produce volumes are down 35% year over year. Imported volumes are down 8% year over year also, and I think that's a big part of why we're seeing such a softening in the reefer market. Load post volumes dropped 14% last week, so as a result, the load to truck ratio went from 8.09 to 6.93. Having a look at the flatbed market, flatbed load post volumes cooled a little bit last week, down 5%, still 12% higher year over year. The load to truck ratio decreased by 4% to 85.64. Having a quick look at our markets, as we started off the show talking about some of the lockdowns, the Shanghai market is China's largest city. It's the largest port. It's going to have long-lasting consequences throughout the rest of this year. Supply chain disruptions are likely. As we've been tracking for the last year, wherever you see supply chain disruptions in port markets and heavy congestion, we generally see a tight correlation with truckload volumes. Import volumes on the West Coast in terms of container volumes down 7% nationally and down 11% year over year along the West Coast. Why this is important, about 46% of all loaded containers come from China. A lot of them come across the Trans-Pacific into the West Coast. So we expect to see a lot more truckload volume in markets that aren't called Los Angeles or Long Beach as shippers try to find other ports throughout the year. In Los Angeles in particular, load post volumes were down 12% last week. Spot rates continue to slide, dropped another 7 cents a mile last week, now averaging $2.42. That's line haul excluding fuel. Rates are now down 35 cents a mile in the last month on the high volume lane to Chicago. In fact, they're down about $1.24 since September. And remember, this is a lane where truckload competes with intermodal fairly aggressively. They're now about 40 cents a mile lower than this time last year. Loads moved on our network are also down about 8% month over month. So a definite softening of the West Coast market around Los Angeles. Loads west of Dallas out of Los Angeles, similar pattern down to 203 this week after being as high as 360 just last November. In upstate New York, in the Finger Lakes region, I think the Elmira market is the one we tracked there. Capacity tightened last week, up 3 cents a mile to 281. Augusta, Maine, rates increased there by about the same amount to 265. We see a lot of water coming out of that particular part of the country this time of the year. Further south in Elizabeth, New Jersey, loads to Chicago are now 7 cents per mile lower at 191 compared to this time last year. Loads south to Atlanta out of Elizabeth, New Jersey, paying $2.28 excluding fuel, which is about the same time as what we were seeing this time last year. So definite cooling off in a lot of the big freight markets in dry van. Having a look at our refrigerated market, one of the stories we've been tracking for quite a while, the leafy green production in the winter salad bowl in Yuma, Arizona, and just south in California's Imperial Valley in Southern California is drawing to a close. We've got about 3 weeks left to run. Why that's important, about 90% of our leafy greens come from this small area in the country. A lot of refrigerated volume typically comes out of the Yuma, Arizona and Imperial Valley. That market is closing. It'll shift back to Salinas, just south of San Francisco pretty quickly. But as produce volumes decrease, so do spot rates in Yuma. Average reefer rates in the Phoenix market, where it's part of, dropped 42 cents a mile in the last month, averaging 247. Loads west of Los Angeles down to 358 after averaging 16 cents per mile higher in February. But we're still about 76 cents a mile higher than the previous year from Yuma to Los Angeles. Long haul loads, pretty big market for Yuma lettuce growers in particular is Elizabeth, New Jersey. Rates have plummeted to $2.15 a mile this week. That's 63 cents a mile lower than the same week last year. Capacity was very tight along the Gulf Coast in New Orleans this week. Rates jumped 90 cents a mile. The average outbound rate jumped 90 cents a mile to 310, excluding fuel. Loads east on the short haul lane from New Orleans to Lakeland were down to 340 after being almost 60 cents a mile higher in the second half of last year. And one of the lanes we've been tracking for the last year is the Las Vegas lane out of Los Angeles. Capacity has been very tight on that particular lane after peaking at $6.35 per mile, excluding fuel last November. Reefer rates from Los Angeles to Las Vegas have dropped by $1.75 per mile since November to an average of $4.60 this week, as more evidence that the reefer market is loosening in terms of capacity. So wrapping up the market condition index look with flatbed, Southeast region is pretty hot this particular week. About 57% of single family housing starts occurred in the Southeast last month. In that particular region, which is about 11 markets on our DAT map, about a 14 cents per mile increase. The average outbound in the Southeast is about 331. Which is, again, fairly normal as construction season ramps up. In particular, Montgomery, Alabama, that market was very tight. Rates jumped 47 cents a mile in the previous week to 368. Loads north to Green Bay today, averaging 251, up 3 cents. In our largest market, in Houston, rates increased by 2 cents a mile to 281, while rates dropped on the number one lane from Houston to Fort Worth, averaging 315 a mile, still 71 cents a mile higher than the same week last year, but capacity is easing slightly. And in our largest steel producing market, in Gary, Indiana, flatbed capacity eased last week. Spot rates dropped 20 cents a mile to an average of $3.60, excluding fuel. So wrapping up now with our year-over-year look at spot rates. Spot market continues to loosen rapidly. Capacity, that is. Spot rates are down 27 cents a mile in the last 4 weeks, following last week's 4 cent per mile decrease. National average is sitting at 239, excluding fuel, now just 7 cents per mile higher than the previous year. In the refrigerated sector, similar trend. Rates were down 6 cents a mile last week, down almost 30 cents a mile in the previous month. They ended last week at 269. That's just 9 cents per mile higher than the previous year. And in flatbed, spot rates clawed back the prior week's losses, increasing by just over 3 cents per mile to a national average of 271, excluding fuel. They've increased by 3 cents a mile in the previous 4 weeks, which is about 30 cents per mile higher than the previous period last year, and about 57 cents per mile higher than the same week in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight or go deeper into some of the data that we've shared today, go to dat.com/market update and download our weekly report, which will be published on Wednesday evening. With that, it's over to Ned for the short-term forecast.
Hello, everybody. We're going to be starting with dry van. In blue, you can see the observed rate per mile by DAT. And then off to the right, you can see our forecast models. In green, our ratecast model is expecting an overall downward trend, although the shape of it is a little more gentle than we see in red with the short term. Ratecast is expecting rates to fall by about 15 cents over the next month, while the short-term model is expecting, something like 50 cents or so of drop continuing into April. In the middle, we have our blended forecasts in gold and silver, which are mixtures of these two models in different amounts and in different ways. They're leaning more towards the short-term model, although they have the trajectory softening a little bit as we head forward, looking like about 25-ish cents of drop over that same period without a significant difference in shape between the two of them. Moving next to reefer, once again, you can see in blue the market rates observed by DAT, and then off to the right, you can see our forecast. In green, ratecast is once again expecting an overall downward motion, but the pretty smooth trajectory out, where it's not doing a steep drop, dropping by about 10 or so cents, it looks like, before in the middle part of April, sort of flattening itself out and getting ready as we move into the later spring and early summer. In contrast, the short-term model is expecting a drop of, if I'm reading this right, about 75 cents over the next month. I think that's a little bit of an overreaction, but that is what the short-term model tends to do. Overreacts to both good and bad news. Our blended forecasts in gold and silver are mixtures of the two models in different amounts and in different ways. They're leaning more towards the short-term model, although overall the trajectory is starting to match the ratecast model as we head into the later part of the period, dropping by about 45 cents during the next month. Finally, looking at flatbed, once again in blue, you can see the market rates observed by DAT. And then off to the right, you can see that there's an overall drop, but it's much less dramatic than we've been seeing for the other models. There's pretty broad model agreement with the overall trajectory dropping by about 5 cents or so over the next month, although there's some disagreement about how exactly that's going to happen. Ratecast is expecting ratecast in green is expecting the rates to turn up by a couple of pennies before it falls in the later part of April, before regaining some ground to land at about 3 or 4 cents down from where we are now. In red, our short-term model is expecting linear straight down to the right, dropping by about 5 cents over the next month. And then our blended forecasts in gold and silver are hewing pretty closely to the short-term model. And with that kind of dire news for people who like high rates, we're going to move into our question of the week, which is it too soon to call this a market correction?
It's a great question.
Yeah.
I don't know. Is it?
I think so. I think it is.
I think it is too. What do you think, Ned?
I'm a nervous soul. I tend to overreact to bad news, and I would want to hold on, but I'm starting to get a bad feeling. I think, we had some conversations internally, and some of our other analysts had some good points about sort of overall seasonal patterns, and the way that things have been right now, maybe those patterns being magnified, but I don't know. It's starting to make me get some nervousness.
So you took a look at seasonal patterns, right? And I think there's some debate about whether it's late April or early May, but the data would suggest what is kind of like the low point, the nadir, if you will, of the year.
I'm going to talk about dry van for just a second. The nadir of the year is basically May, early May.
And I think depending on how you slice it, it could be late April, which is what my lived experience would have indicated. But I think late April, early May on a national. And again, a lot of this is going to vary based on where you are in the country. And in Southeast Georgia, it's going to be a lot different than Northwest Washington, for example. So right now would be the strongest negative seasonal pull of the year. Pretty much is where we're sitting over the next month and a quarter.
For dry van and reefer, yeah. Flatbed has a very different pattern. So
you want to hit on that real quick? So right now for flatbed.
Flatbed has again, we're looking at national flatbed rates, and obviously like different markets have different behavior, but the overall flatbed pattern is strong in the summer and weak in the winter and fall. And
makes sense, right? Yeah. No one wants to be out there strapping and tarping loads and checking strapping in the middle of winter. If it's ever going to not be winter here up north. So another question, just to level set this discussion, is why do we look? So most brokers negotiate spot purchasing, so carrier reps, whatever they're called at your specific company. Mm-hmm. They're negotiating all in. Why do we break out fuel?
Because fuel does very strange things. I feel like most people are now quite familiar with the fact that fuel can change remarkably in relatively short periods of time when the underlying market fundamentals haven't changed. And so you need to keep that cost in mind. And if you are lucky enough to have some kind of a fuel surcharge program, that can help cushion you against these kind of fuel shocks.
Well, I would add too, I think that's a very good answer, Ned. I would add, don't fall victim to the old school kind of hand wavy, we negotiate all in so fuel isn't important. I can say this with absolute certainty based on my experience and the live experience of multiple colleagues of mine throughout my time in the industry. You are operating from a better pricing and negotiation position if you are aware of how fuel is changing in the underlying rates. It's why we break it out in rate view. It's why every bit of analytics I've ever done in the industry thought about fuel separately from line haul. Even if we were ultimately packaging up into an all-in price, every bit of forecasting analytics I've ever done has really thought about fuel accessorials and base. But for the simplification here, let's just think about base and fuel. $1,000 load that you moved 4 weeks ago is going to have a drastically different underlying allocation between fuel and base today than it did 4 weeks ago. And it's important to be aware of that, even if you're still paying $1,000 to move the load. Thoughts? Yeah. That's my opinion. Well, that's my kind of blended. That's my opinion.
I mean, carriers can't eat fuel, right? Like if you're a broker, your carrier, your counterparty's operating costs go up, and so they're going to have to negotiate harder in order to have the same standard of living.
Right.
Yeah, I mean, it's a very real cost for carriers, and I think that's why it's important. I think brokers could get into the trap of, I'm just trying to maximize my gross margin. I'm just trying to cover this load. Again, even if you're in a very unstructured environment where you're not getting pricing guidance from a pricing department, let's just say you're an independent agent at one of the large agency brokerages, definitely be aware of the underlying changes between fuel and base. Because those are very real for the customers, right, that you're working with. Customers in this case being the capacity.
Yeah. I mean, Dean, do you have any extra perspective on this?
Well, I've just been quickly doing some modeling while we've been talking here. And so in terms of operating costs, fuel's sitting at about 46% of operating costs. And this time last year, it was 39% of operating costs. So we've seen diesel, if you're just running a single truck 100,000 miles a year and 10,000 miles empty, diesel's gone up $33,000 annually, whereas spot rates have only moved up your top line by about 8 cents per mile. So we've seen about an $8,000 impact on top line revenue and about a $33,000 impact on operating costs. It's decreased the profit margin by about 75%. So carriers are still, they've gone from making 55 cents a mile gross profit this time last year to 14 cents a mile. So it's in a 41 cents per mile swing in gross profit margin, a drop of 75% in just the last month. That's an acute impact on operating costs. A lot of carriers won't be able to weather that because it's such a high percentage of their operating revenue, of their the variable costs. I think the more important number, though, is that fuel as a percentage of revenue is up to 36.51% as of this week. In fact, I think diesel's gone up a little bit more since we spoke. It was up to $5.18 last night. So that's pushed that number up to closer to 37% now when I adjusted for the EIA number that came out last night. So it's a pretty big deal for carriers. This is one of those moments where carriers start to reevaluate all of their options. Anecdotally, some carriers I know have been just sitting on the sidelines, just waiting to see what's going on. Some are, changing their operating behaviour, fewer deadhead miles, being more careful about lane selection. So, not sure where this ends. A lot of volatility. Prices are going to be very slow to come back down, even though some of the commodity markets are dropping fairly dramatically. Retail's staying high by the look of it.
Yeah.
And why wouldn't it, right? I mean, there's no huge incentive right now to hand back those margins that they haven't been privy to for the last couple of years. So, again, I can't stress enough how important it is to keep tabs on what's happening in the underlying allocations between base and fuel. I think that advice is beyond important, and I think mainly well known amongst carriers. But, you're filling up, right? When you're at the pump, it's hard to forget that that's a real cost. I think as a broker, again, it's easy to abstract away those two pieces. It'll be really important when things start to flip and diesel prices go back down. Right. We should almost have like a little graphic that tracks like this hypothetical $1,000 load that went from $1,000 with an 80-20 fuel split to 70-30. What happens when fuel goes back down to that historical 20% value? Do we go back to 80-20, or does the whole total come down to 90?
Yeah.
I think those are really big questions we're wrestling with internally, because in the past, the market has not given back that base allocation. That's why we stress so much about this, right?
Ken, I'm not sure who it was. Someone said the other day that rates were stupidly high, and it kind of struck me that that shows kind of a lack of regard for what it really costs to run a truck and trailer. Because right now, with fuel where it's sitting as it is, I'm looking at $2.04 per mile operating costs. And we heard from Todd Amon on last week's show that in 2021, operating costs had gone up 20 cents per mile. That was before diesel moved up well over $1 in the last month. So I'm sitting at about 204. Spot rates are sitting about 235, thereabouts. Gross profit margins down to 13 cents a mile. I wouldn't say rates are stupidly high, but I think the bigger question is, provided everyone has a good understanding of their operating costs, everyone should realise that it's costing truckers a lot more to operate their equipment than it did 6 weeks ago, and certainly what it did last year because of the inflationary effects on all of the inputs into running a trucking company.
Yeah. I mean, we don't have as much room is how I've been describing it to folks who are a little bit unfamiliar. And it's easy to show with charts. Like if you graph, maybe we should pull one, like zoomed in on the year over year, right? We show a few stacked years. It's easy to say, well, we're a long ways away from we were in 2019. We're a long ways away from that cost base too. Right. Diesel was below $3 a gallon then. I believe it was like $2.97 at the depths there of when things were kind of slowing down. So I think it's a multi-sided problem, and it's important to consider both sides of a multi-sided problem, right?
Yes.
I mean, we're all making more money than we ever have, and then we go to the grocery store. I mean, it's I think the only people who benefit from inflation are people that work and don't spend anything.
People in debt, heavy people in heavy debt, heavy dollar denominated debt.
heavy old debt, right? Anyone taking on new debt. My brother's trying to buy a home right now. Good luck. My buddy's trying to lease a car. Good luck. It's like interest rates can be gnarly things whenever they start to get above, what we've been trending over the last 10. We've been very spoiled, for lack of a better term. I mean, I refinanced my home at like 2.2%. That's free money. So again, very few truck drivers are buying their trucks in cash, right, Dean?
Very few. Not even the ones at the truck show last week with $500,000 sunk into them in chrome and stainless.
So keep that in mind, right? These are all costs.
Right.
So we have any? We do.
Yes.
I haven't heard from Matt Clark in a while. It's good to hear from him.
Yeah.
I'll take Lee Chung Pounds, though, first. Why are spot rates for reefer truckloads continuing to fall? How long do you think it will continue, or are we closer to the bottom or top of the range for reefer spot rates?
I think this is seasonally, right? We normally see a seasonal lull about now. I think the important point here is we're coming down from a much higher level where we ended off last year with incredible disruption, a lot of urgency to move freight before the Christmas holidays. We saw rates ramp up pretty high, especially in food services sector. So I think the point here is that we're coming down from a much higher level. I'm not surprised that rates are dropping down seasonally. And of course, you could infer from that comment that we're at the bottom, but that would be a dangerous thing to put your reputation on at the moment, given the way the market volatility sits. But we normally see an uptick in spot rates from now, certainly from April. Once we get into mid-April through July 4 is when we'll see some upward pressure on spot rates in the refrigerated market as produce season ramps up.
Yeah,
I think we need to be very careful. So this conversation, just a little inside baseball. So we have a couple. Slack is like an instant messaging tool if you're not familiar. So we have a couple analyst Slack channels at work, and we've just been having a lot. I mean, I think we are lucky to have probably 50 very, very, very good analysts in that channel that have really good perspectives, right? So it helps us build context and pressure test ideas. And I think it's helpful to keep circling back to the sky is not falling. This is normal. This is an extraordinary. The only certainty really in the trucking market is the cyclicality of it. And we've been, I think Todd said it last week, Todd Amon at ATBS, we've been on a 2-year bull run here, unlike anything we've ever seen before. And frankly, the last down cycle was relatively, and again, I understand this is easy for me to say. I didn't go bankrupt or almost lose my home during it, so it was a relatively short-lived down market, right? So the tail end of 18 started to bleed off. 19 was very slow. COVID started and then out of a cannon. So all things remaining equal, we would expect a cyclical slowdown lasting 18 to 24 months to start sometime this year. So before any of these diesel, before Ukraine, before any of that, we were talking on this show that sometime this year, that down cycle is going to start. May have started a little bit early. We may get some reprieve heading into produce season. And then after the 4th of July, we see it flip. But I don't, as high as it was, there's a possibility to go as low as it was. You know what I mean? So just keep that in mind. The sky is not falling.
Matt Clark has a question. Dean, on the rates, would you say the drop-off is related to less demand rather than more capacity in the markets? You mentioned a 35% drop-off in produce.
It's a great question, Matt. I just did some numbers in the background here. I think it's a combination of both, but I think it's more so driven by the amount of capacity that's entered the market in the last year. If you look at the folks that are operating primarily in the spot market, in terms of the new entrants, we've had 114,000 new companies join in the last 12 months, of which 86,000 are owner-operators. So they have a heavy exposure to the spot market. And as I've been saying for about 6 months, we don't have a driver shortage. We just have trucks not cycling through freight networks as fast as they would normally do because they're sitting on labour-starved warehouse docks for a lot longer. So now that demand has eased and there's some more fluidity coming back into the markets, we're seeing trucks cycle at a much higher rate, and suddenly talks of a driver shortage have all but disappeared. So I think we've always had more than enough trucks to meet demand. And what we're seeing is exactly that now. As demand dropped off and trucks started to move through networks faster, suddenly we appear to have a lot of capacity in the market and spot rates are dropping. So that's exacerbated, of course, by what looks like an unusual drop-off in volume on the produce side. And again, I think that's seasonally normal. We're not sort of reading too much into it, but we need to watch the coming weeks to see if that's a trend in the food services industry. I don't think it is. I think this is more of a 1 week change. And Matt, we do see some of this coming through the USDA data. There is a little bit of lag in the data, but we do see some pretty big swings in volumes week to week as the volumes are getting reported in from the various growers and brokers.
It's been cold too. I mean, when I was in the industry, we would track broad weather patterns. I mean, a produce season starting a week or two late could very much be attributable. It's been cold.
Right. And we're not seeing the volumes that we normally would out of Florida, right? I normally see a lot more upward movement out of Lakeland and Miami. It's going the other direction right now.
It'll pick up though. I mean, that stuff, it's Mother Nature can be fickle.
Right.
Yeah, I think too, right? It's really going to be hard to understand, I think, as we get through this seasonal uptick. It's going to be hard to disentangle what's seasonality and what's trend. And that happens every year. We're always on some part of a curve. That's kind of the hard thing about freight, right? We're always either going up or going down. Very rarely are we at that like weightless feeling on a roller coaster. Very rarely are we there. We're always generally on some part of an upward or downward sloping trend. So it'll be really interesting. I mean, if you look at what 2019 looked like, the downtrend was enough to subdue pretty much all spring seasonality. The 18 or 17 was the exact opposite, right? It accelerated that seasonality. So it's going to be really tricky, but we're going to do our best to help keep you all informed on what's going on out there. But I think, too, to kind of build on Dean's point, we are absolutely seeing more freight transact contractually than on the spot market. There's just really no doubt about that. We're seeing routing guides stay more intact. When routing guides stay more intact, less freight comes to the spot market. It seems like the last 12 months of shippers frantically attempting to get RFPs and carrier capacity locked down is starting to bear fruit and become successful. That will take freight out of the spot market. It will. Unless there's new freight created, more moving in contract means less in spot. It can't move in two different places.
Right.
That should be DAT's law. We should start creating a list of DAT. I mean, freight can't move in two different markets. It's got to move in one or the other unless there's new freight being created. Or the opposite of that is like if there's that less overall freight moving, sure, the number could be net zero. Right. But on a week-to-week basis, I don't think we can make broad sweeping assumptions about how much freight en masse is moving. Let's just assume it's holding constant. If more is moving contractually, less is going to move spot. We're seeing that in the load-to-truck ratios, load port activity. The contribution data is a little tricky to measure in absolute sense week over week, just given how some of it rolls in. But we're keeping an eye on it.
We are.
We're keeping 6 eyes on it at least.
Yep.
Probably more. What else?
That's it for the listener questions.
Yep. Do you want to do some shout outs for the shows we've got coming up?
Yeah. So go ahead, Dean. Why don't you start?
There'll be a bunch of podcasts coming out as a result of all of our interviews we did at Matt. So we'll let you know about those on the upcoming show. But tomorrow we'll be on Landline Now on Road Dog 146 on Landline Now at 7 p.m. Eastern. And in the morning, I'll be on live with DJ Flores and Dan Deegan on Sales Chatter, their daily live show at 9 a.m. Eastern.
Excellent.
Cool. I got to try to get on that show again. I love spending time with those guys. They have a really good format, and it's always a super fun conversation when we're talking.
We're talking about the Canadian spot market tomorrow. Now the latest reports out from LoadLink. They've seen some incredible volume back in the market as a result of all the blockades in February. A lot of load board activity, as you'd expect, as shippers were trying to get capacity to move loads into the US. Great discussion.
Yeah. Ned, maybe we should tease, we have a little bit of a UI available for this super secret rating project you've been working on?
Yes, don't hit it too much. It's very fragile.
What we should do is get Cole, one of our new IQ product managers, on the show in the next couple of weeks. Maybe in a couple. I'll bug him and get him on to talk about. He was down at Matt's with an iPad, being very careful to baby the little UI we got, and getting a bunch of customer feedback about this new rating tool. So maybe we'll have him on in the next couple of weeks to talk about it. I think that would be good.
Yeah, I agree. TIA, do we?
TIA is coming up in a few weeks. I will unfortunately not be there. I will be
next week.
Is it next week? Yeah, it is, because I'll be mired in academia next week.
Be there. Yep, forgot that one. Gosh.
TIA, we have Supply Chain Leaders in Action coming up. We'll have our symposium coming up, which will be really cool. That's in May. It's always a good time.
Right.
Yep.
So the calendar's moving along as it does. It very rarely stands still.
Yep, it's conference season.
It is conference season. All right, well, I want to thank everyone. Sorry, what were you going to say, Dean?
I'd say it's back. Conference season is back.
Yeah.
You know, it's before the summer break. This is sort of peak season for conferences and in warmer places.
For sure. All right, I'm going to sign us off. We're running a bit long this week. If you have any questions, askiq@dat.com. We're always standing by there to answer your questions. And I will sign us off for this week, but I hope you join us next week when we'll be back at 10 a.m. Eastern. Have a great week, everyone.
Thank you.
Bye all.